So will Tattoo Chef soon show any profitability? Because as we know in today's market, it isn't very forgiving when it comes to companies that doesn't show profitability or aren't close to it. Now that is something we're going to take a look at today. If you're new to the channel, then welcome. If you're not, then obviously welcome back. As always, I would appreciate an early thumbs up to help spread the video to more people out there. And if you want to be updated on Tattoo Chef and all the plant stocks regarding Beyond Meat, Oatly, and the Very Good Food Company, to name a few, again, 5 days a week, then make sure to subscribe and don't forget that bell button. And feel free to join our free Discord channel that you have down in the description. Thank you, folks. I truly appreciate your help. So today I thought we could look at a recent article that's been written in Seeking Alpha that actually is called Tattoo Chef, a winning brand in our rocketing plant-based food industry. And folks, I use Seeking Alpha for all my different investment purposes, especially having some form of tool when it comes to looking at earnings and also looking at articles that you can't find anywhere else. If you are interested in Seeking Alpha, guys, then take a look down in the description where you get a 50% discount. But also you get like up to 1 to 2 weeks of free access just to try it out. So again, guys, take a look in the description. I get a commission on every sale. First of all, in the article, he starts to describe basically the industry and what we can look forward to in plant-based companies or the plant-based industry. And as we know, he states that we could see the whole industry growing from about 29.4 billion now in 2020 to about 162 billion by 2030. And we know that this whole industry is a growth beast. And he also states something very interesting here, as I think we know that it is Gen Zs and millennials, like he calls millennial hipsters, that is one of the targets here when it comes to Tattoo Chef and plant-based companies. But he wants to make sure that we understand that it's not only going to be that generation that's going to focus on it, because it's actually spreading to a lot of different demographics. And when he's talking about the brand, like we know, guys, we've talked about that many times, branding is everything. He reminds us that when Sari Galetti actually came into the company back in 2017, a lot of things started going in the right direction. It started to take off. And he also points to the fact that this whole ESG industry, which has to do with environmental sustainability, that's driven by social movement. And again, that branding is everything, and Tattoo Chef is perfectly placed there in time and space. And I actually do like what he states here that I'm going to read for you, is that, quote, "At the end of the day, consumers are not grabbing plant-based meals from freezers because they taste better. Plant-based consumers want to feel healthier, more socially responsible, more cultured, and everything else that comes with ESG preferences. Therefore, I believe consumers will be more likely to grab a Tattoo Chef meal rather than a generic Stouffer's alternative if TTCF can continue to build its brand." And that is obviously a very interesting way of looking at it. We know that people today care a lot more about the environment and sustainability. And if it is, as he states, that it's not only Gen Zs or millennials, it's the average Joe today that are going to be interested in buying plant-based food like Tattoo Chef's products out there. Well, obviously, this will take off then a lot in the future. And he also talks about their aggressive branding strategy that they've had now in the last few years. And it points to the fact, which is very interesting, is that from Q3 2020 to Q3 2021, as we know, the chef actually increased their retail presence from 4,000 stores to 13,000 stores. And which is interesting considering that they were only expecting 10,000 stores, right, in the end of 2021. And already in Q3, which would be in the end of September, they were up to 13,000 stores. Now, what I'm interested in hearing is now in the Q4 report that's coming up now in a couple of weeks from now, is that if they had 13,000 stores already in the end of September, what could they be up to now? So guys, let me know down in the comments. Do you know anything, or what are you expecting here? And it also mentions here of the top 10 plant-based frozen entries SKUs in stores, this chef has the first and second top products since their launch in March 2021. And I think he's basically also talking here about Target for one. And you can see them here, right? First place, the second place, and then we have Stouffer's, Amy's, Avon, Healthy Choice, Amy's, Lean Cuisine, and Lean Cuisine. So that's quite impressive considering that this is a brand that's basically only been out there for 2-3 years, taking this kind of front seat. So really impressive. And something we've talked about often, which is one of the things we like most about TTCF, is that it's a vertically integrated business model. And that is something that's obviously going to help them in times like these with higher inflations. And as he states here, quote, as previously states, the company grows its ingredients, manufactures, and designs its products before selling directly to retailers or private label businesses. This allows the company to quickly pivot to take advantage of trends with the industry in less than 3 months, making its brand flexible and swift to address new consumer tastes. So again, folks, this is probably one of the reasons why a lot of investors are interested in this company, because there are not any, I don't think there's actually any other plant-based company out there that's right now vertically integrated. But he also talks here about the recent Belmont Confections and New Mexico food distributions actually gives them the ability to be able to produce up to $600 million in revenue through all of those together, which gives us an idea, as we talked about, that to be able to actually reach that $1 billion, well, we're definitely going to need more facilities in the future. But seeing as we're still only around 200 to 210 million, and 2022 might be around 300 million, we're pretty far away from that as of yet. But I think it was around 2026. So we'll be monitoring that for sure. And then he talks about their financial performance, and we know it hasn't looked that good when it comes to the last quarters from Q2 and Q3. As it states here, the OPEX, the operations, basically increased from 7.6 million to 13.6 million. And that's something that a lot of people are critical about. But you have to factor in, as he states here, that it's not so strange considering that they have acquired several new facilities and actually are growing the company rapidly. So these costs are to be expected. Like we know, you have to spend money to make money, right? But he does give us a little nuanced perspective here, even though he's very bullish. And that is the thing about the margins that we know that has been shrinking, right? It's gone down now to about 10.1%. And the negative thing here is that the company is not expecting anything much higher in the near-term future, about 12 to 14%. But as the author does say that he's hoping that these gross margins will actually stabilize as inflation is reeled back into control. And that's going to help them obviously getting some better results in the future. He does say something that we were focusing on in this video, and it comes to, like he states here, that the revenues has so far grown about 63.4% average since 2018. Obviously, we need to have a nuanced perspective of that. That's not going to be the case this year probably. And in the next couple of years, we might see around 30% growth, which is still really good. But again, they need to work on those margins. But what we are looking for is to get some kind of indication when could the company actually be profitable. And he actually talks about that it could be around 2023, late 2023. And he's not the only one. He hasn't just said that from out of the blue. If we go into the actual Q3 report here, we have Stephanie Diekman, who's actually, the current CFO, who stated that here we could see, quote, "We are aggressively growing Tattoo Chef, and we're going to continue to spend aggressively in marketing for 2022 and in promotions. You will start to see some profitability in 2023, and we really think that the back half of 2023 is when we foresee some of that turning around." Well, without getting too specific. And I will give some comments on that in the end of the video, which we are reaching soon here. But then he comes to what he calls performance and talks about that, it's been a really volatile history with the chef. and I think we all know that. He gives us some advice that if we are interested in this company, we need to think midterm to long term, because the price we pay for being invested in a growth company, in a disruptive growth company, is a lot of volatility, a lot of stomach ache if you're not prepared for it. And as we know, in May 2020, it started as a SPAC. A couple of months after, it flew up quite high to around $17, $18, went down again in September, and then eventually flew up in October to around $28, and it's been a roller coaster up and down since then, and now it's around $11 to $12 here. And he also does say that we know, I think all of us know, the company is right now obviously overvalued to a certain extent, but as he says, it's justified given that it is a growth company and that it does have a lot of high potential. And in his conclusion, obviously, this is a buy, but again, a buy for the mid to long term. And he does warn us that there will be a lot of volatility still in this company, so you have to be prepared for that. But as he ends it with here very well, quote, "For those willing to ride the stock for years to come, however, TTCF has the potential to provide solid returns if its brand continues to grow and management can keep OPEX manageable." And that's what we're hoping for, right? Getting those operational sums down a notch. But I imagine as they grow in the revenue, the company grows, sooner or later, these prices will come down and the revenue will go up. So now I'm not worried about that. Well, I think this was a very interesting and well put article in many ways. It was quite simple. It didn't go into many depths though, but I don't think that's necessary all the time. We know that this company could be a growth beast, and they are placed in a sector that is going to be a beast mode now in the next decade. And as you know, from a long-term perspective, I am bullish in this company, but I do share some of the concerns regarding the margins, the 10% margin, and that they only will have about 12 to 14% in the near-term future. But you should also be aware, and I think you do know that this is actually typical for frozen item companies. 10% margin is usually the standard there. But obviously the hope is that the margin will get higher with time, as will the revenues, because they're not interested in only remaining in the frozen section. They want to expand to different categories, as they're doing now. As we know, they're moving into bars as we speak, and they basically want to be in all places and different areas in the store. And if that happens, obviously we could expect those margins to go higher. And it is my hope that we could see those operations, those OPEX expenditures actually becoming less and less with time, becoming more effective with time. But it's not so strange, again, given that they have been expanding like crazy as of late. And I really hope that we could see them becoming more profitable in the end of 2023. And if that happens, I do believe that we could see this stock taking off more and more. Because right now, as I said in the beginning, companies that aren't profitable will take a beating in the market. However, just to keep this a bit more nuanced, we need to remember that so far, especially in Q3 and Q2, the management haven't been really good at future projections, as we know. And that could be the case also for this when they're actually hoping to have profitability. But then again, in their defense, 2021 was extraordinary, right? Not only for the Tattoo Chef, but Beyond Meat, Oatly, and several other companies out there, especially growth companies. So we should give them a benefit of a doubt. And unless we forget, even though there was a lot of people who felt a little disappointed with the Q3, guys, it still was about 44% increase year over year. And what we're looking for is the Tattoo Chef branded products, right? That actually increased about 56%. And that is what we want to focus on. All right, folks, that was it for today. I hope you got a lot of value from today's video. And if you did, make sure to smash that like button. And if you want to keep getting more videos regarding the Chef or Beyond Meat, Oatly, to name a few, then subscribe and don't forget that bell button. And feel free to join our free Discord channel. And as always, this was not financial advice. These are just my own thoughts and opinions. All right, guys, hope to see you soon. See you tomorrow, and peace out.